To the workshop meeting, Narberth Borough Council for Thursday, July 2nd, 2026. We do not have a quorum here tonight. I'm leading this meeting by consensus, I think. Do I have a consensus to lead this meeting? My name is Jim Spear, so I'll be temporarily chairing this meeting. Thanks. And first on the agenda is a call to order, and the second on the agenda is the Pledge of Allegiance. Mr. Mayor, can you lead us, please?
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. Okay, it's time for a roll call. Ms. Manager.
I'll do who's in the room. So we have Councilmember Savinson.
Present.
Councilmember Spear.
Present.
Councilmember Gaudini.
Here.
And Mayor Dana Edwards. The balance of our council members, including President Bush, Vice President Rickards, Councilmember Borough, and Councilmember Stratton are absent from tonight's meeting.
Great. Okay, President is not here. Let's dispense with President's comments. Mayor's comments?
Yeah, I think the number one, just to remind everybody that the heat is very bad. Check on your neighbors, stay cool, stay hydrated. Number two, I would say the activities are still a go for the weekend. I know there's a little bit of rain in the afternoon. All signs are that it'll continue on. Just remember that it starts at 10 a.m. with a bunch of family fun activities, pie eating, baby parade. I've heard that's very competitive. We're going to one, we'll see. And then we take a little bit of a break in the afternoon and we come back together at 6. We start things up. We've got the band and then fireworks are expected about 9:15. And they're going to be bigger than last year. So it's good news there. I've gotten a lot of really good feedback about the work that the borough has been putting on around the music events and the last event that Ed was leading for us. But in particular, yesterday's music event, the concert series was very well regarded. So thank you to all the people who put it on, the volunteers, and of course to the borough who never takes credit for those things, but should take a little more because it's some really good work you all do. And with that, I will leave the balance of my comments will come during the presentation.
Great, thank you. All right, we're moving on to discussion items, and our only item today is a presentation from Planning Commission. Planning Commission member Aaron Graves is here. Welcome. Thank you for preparing this presentation. Thank you for giving us your time. And the topic tonight has to do with zoning. We are calling it development economics. Sort of educate ourselves a little bit about the nature of the Planning Commission recommendations from earlier this year and the math behind it. I know a lot of us are curious about that. None of us is an expert. I know I want to know more. So I'm glad you could come, and I think I will turn it over to you, Aaron Graves.
Thanks, Jim. I'm going to stand here. Where does the camera, is the camera on?
It follows you.
It follows, yeah. So you can sort of stand anywhere.
Okay, cool. All right, love it. Well, thank you, everybody. I really appreciate it. Thanks for coming out. Aaron Graves. This is one of my favorite topics. I do this as a profession, which is raise capital. Background has been in CRE finance for 19 years. I've been in Narberth for 10 years, so I'm a resident. And as Jim said, I'm a member of the Planning Commission. So today's agenda and goal really is to go a little bit behind the numbers on development, how developers think about it, how investors think about it, the trade-offs, pros and cons of adding a little density, and then at the same time, the pros and cons of adding what I'll call workforce housing, which for those of you who aren't familiar with it, it's essentially roughly folks with about 80% of the area median income. So it's folks making about 75, 80K a year. And a portion of those units are set aside for those residents. So with that, we'll dive into it. And that's how you go. So now next slide. So before we get into that, we got to take a step back and talk a little bit about CRE fundamentals. We'll go over some basic definitions. We'll talk about the risk return of real estate. We'll then go into agenda 2, which is why is it harder to develop today versus 4 years ago when interest rates were essentially zero, right? So we'll talk about why it's harder to get deals to pencil. And then we're going to go through an example. And in full disclosure, this is my example. I'm not seeing anybody's pro forma and, 5B, 4A, etc. This is just me as a real estate professional, knowing what I know about the business. If I were developing an arbor, this is how I look at it. Okay? So, with that, let's dive in. All right. So, real estate liquidity premium. This is where it all starts. I think we can all agree that real estate carries an additional risk to it as opposed to stocks and bonds. So you've got the U.S. Treasury at 4.5, you've got corporate bonds at 6, 7, you've got the stock market generating 8 to 12, and then you've got real estate, right? So it's an operational intense asset. And also it is fairly illiquid, meaning you can't buy and sell it at a whim. You need a lot of capital to buy it. This is commercial real estate. And there's a lot of risk that goes into it, right? So within that real estate premium, there's separate kinds of real estate, right? We can all agree that a multifamily property is safer investment than an office property, right? COVID, think about what happened, right? So staying on the multifamily track, within that multifamily track, you have core real estate. So this is stabilized multifamily. Just buy it, don't have to do anything to it, rent it out, etc., right? You have the value add multifamily, which is going to carry a little bit more risk premium to it. That's when you buy a property, you renovate it, you push rents, and you sell it. So there's going to be a premium to the stabilized. And then you have development multifamily, which is really the most riskiest piece of the equation. Why is that? Well, for development, it often takes 2 to 3 years just to get the entitlements, right? And then you've got to build it. So the construction, that's another 3 or 4 years by the time it leases up and stabilized. So from start to finish on a multifamily development project, it could be anywhere from 6 years to 8 or 9 years before you see that investment return come back. So as a result of that, there's more premium in development, okay? You're taking the construction risk, you're taking the cost overrun risk. When you develop that multifamily property, you don't know what type of environment you're going to deliver into and what you can ultimately sell it at. So there's a risk premium associated with development. Typically, that's about 15 to 20%, okay? So keep that in mind. We'll go to the next slide and we'll jump into components of that. So this slide's a little hard to read, but I really enjoy it because I think it's important to point out. So,
Sorry, what, remind me, you want a question as we go?
Sure,
Or,
sure.
okay. Can we go back to the next slide real quick? Easy question. For the last two, I'm going to skip private equity because that's a whole other thing. For the last two, in your experience as a banker, how many projects actually fall into those ranges and how many are like higher, like just rough percentages, how many fit in there?
in terms of deals or
Realized value, because you're talking IRR.
Yeah. I mean, it's, I don't know the stats off the top of my head, but there's a lot more liquidity investment in the value add space. So you have all kinds of shops that'll raise capital, raise equity, they'll buy existing properties, they'll renovate them, fix them up, and either hold them or flip them, right? So that's a very big component of the multifamily space as a whole. I mean, if you think about it, how many development deals get built, especially around here in the suburbs, right? You can go down Montgomery, there's 1 million apartment projects, right?
Yeah.
People own them, and people will then buy them and renovate them, and they're going to stay multifamily. So that's, I would guess, 70 to 80% of the market. The development is much smaller. You have specialized developers that take the entitlement risk, they take the construction risk, and are trying to get it out of there. So maybe that's 20%.
Fair enough. Thank you.
Yeah. Next one. And so on that point, that's actually a good segue. So within a real estate property, this is the capital stack. You've got debt and equity. And then at the very top, you can see the developer. This is the sponsor, the developer, the GP, we like to call them. They typically are 5 to 10% of the equity. So they take the zoning risk, the entitlement risk, they put their guarantee on the line for the construction loan, cost overruns, etc. So they are actually a very small piece of the equity. What they have to do is they have to go raise the equity, okay? And that's where that equity goes back to that return for development into that 15 to 20% category. That equity is going to require that 15 plus return to take that risk with the developer. Then you've got the debt, construction loan, 60, 65, 6-8% rate, and you got everything in between. So I don't want to spend a ton of time on this, but the point is, a lot of times the developers are entitling the deal and also bringing 5 or 10 million into the deal to get it off the ground. And for particularly, I want to touch on this as well, for smaller project sizes, when I say equity, this isn't, necessarily private equity. This is a lot of friends and family money that's coming in, raising it, friends and family. So for smaller deals. Once you get into the bigger ones, you've got pensions, endowments, you've got, life companies have money for equity and they'll come into the development stack for bigger deals. But for around here, this is friends and family.
Sorry, can we pause for a second? It looks like we got kicked off of our Zoom.
To continue?
Okay.
So people.
Oh, I see. So yeah, our internet went out. So we're restarting the meeting.
We haven't been talking.
I'm gonna pick up where we left off.
Pick up where we left off, sure.
Are we good?
Yeah.
All right.
So can I ask you?
Yes, Mike.
So does the debt profile change based on the size of the project? Like I would imagine that somebody needs to borrow a lot more money to build a 45-story building than a 4-story.
Yeah, that's a good question. It can to some degree, but generally the most senior stack, the senior debt cuts out around 60, 65 LTC. So that can be for a smaller deal, it could be a bigger deal, but that's generally kind of where a lot of the banks and life insurance companies want to play. They get a little bit lower return for that, staying at 60, 65. That's where the mezzanine debt is and sort of the pref equity. So for a larger deal, for example, kind of getting to your question, let's say it's a $100 million development deal. The senior loan would be about $65 million. And then what is that, 35 million of equity, So you can go up higher leverage. So you can start taking, what we call bridge debt. Those tend to be more of the private credit funds, and they'll take a little bit more return for that. So they will go up the scale, and it shrinks the size of the equity check. But ultimately, that market cuts 70, 75 LTC, and you still got to fill it with equity. And when you go above that, that's when you need a higher return for the equity, right? Institutional, friends and family, whoever it is. So, because to Dana's point, that debt is the first to be repaid, so it's the lowest cost. Good question. All right, so we got to hit some foundations. Really, 3 slides that you need to understand when we get into the development example. The first one is NOI. And I'm just going to be very basic, so apologies if some of you already know this, but this is the net operating income of the property. It's simply the revenues of the property less the expenses comes with NOI. This is where everything fundamentally runs off of. So every property generates some sort of cash flow. This is before debt service, so it's like the company's EBITDA, if you're familiar with that, but it's basically what everything runs off of, okay? So this is building block one. Next slide, please. Cap rates. This is effectively a value of the NOI. So said differently, the NOI over the property value is your cap rate, or the NOI divided by the cap rate equates your value. So generally speaking, the multifamily cap rate today is about 5.5%. Okay? You might ask, you just told me the returns need to be 15 to 20% for development or 12 to 15% for value add. That is true. This is an unlevered, basically, return. So if I bought a $100 million deal and I did no debt, I would expect to get a 5.5% return on my $100 million investment. When you add debt to it, the leverage amplifies the equity returns, and that's how you generate, the equity can generate those higher returns, okay? Now, what makes up a cap rate? I did not have time to cite Peter Lemon, but I think I got this from him. He's a Wharton real estate economics professor. Love him, great podcast. There's a lot that goes into cap rate. Mostly it's correlated with interest rates. So if you've got the risk-free treasury at 4.5, to buy a real estate property, you're going to want a premium to that, right? So then you've got the NOI growth. So if I think a multifamily property the rent's going to go higher, I'm going to be able to pay more for that, and the cap rate's going to come down. Supply capital. So this is, multifamily is very liquid, one of the most favored of the real estate and office, retail, et cetera, right? You get a lot of capital coming to multifamily, so that keeps that cap rate for multi down. In office is going to be a 10 cap, for example. And then risk aversion. So that's it's a lot, but typically you'll see sales comps, you'll see, I don't know when Maybrook last traded, but there'll be a cap rate rent, okay? So it's the value. Next slide. Yield on cost. So this is developer lingo.
Sorry, can we go back one?
Sure.
I just want to make sure we caught that. So like cap rate, I don't know that it's a quarter each of your chart. Maybe it's more on interest rate, right?
Yep.
But if the interest rate drops, cap rate would drop.
Tends to.
Okay.
Tends to. Yep. So, and I'll go into that in a minute, but I'll come back to that. I'm going to show what happened. Okay, yield on cost. This is developer lingo. I will use this, so I'm going to get you familiar with it. The premise here is, if you're going to go into a development deal and you're going to build a development deal and you're going to take on the risk and you're going to take the 8 years to come up with the entitlements, construction, and stabilize and sell, you're going to need a risk premium above today's cap rate, okay? I'm not going to build property at a 5.5 cap when I can go buy one at a 5.5 cap, okay? So development requires a higher yield. So this is the yield on cost. So I want to build it lower than I can sell it for, okay? That's the yield on cost, the NOI over the cost. And that risk premium is basically what determines if the construction deal is feasible. So if you went and you did the IRR calc, figured out what your rate of return was, I'm going to build a property, and in 5 years I'm going to sell it, and I want that risk, the yield on cost, to be about 150 bps. And I'm going to today's cap rate. Okay, that's the premium. That gets you into that 15 to 20% returns that these developers need. And I'm covering a lot, so. Good questions?
When you look at something like this, so the financials are sound, I get it.
Mm-hmm.
X divided by Y, I got the numbers right, all good. So fine with that. Do you look at this, like when I think about like financials and a developer wanting to do something, that's sort of explaining that. Are you suggesting that we should take this into consideration when creating policy?
I'm not suggesting that. And I don't know the right answer to that. I mean, when things come through the planning commission, we're just looking at sketches. And it's like, we never even see the developer's pro forma.
Yeah.
Right. So, I don't think there would be any zoning out there locally or nationally that essentially requires that as part of the process, but it's a good question. But it does go to the point that I'll eventually make, is every development deal does stand on its own to some degree. A developer may have a great land basis, right? And the deal works, or they may have, in today's market, may have a bad land basis and they can't get out of there. So it just kind of is. It's a good question. Okay. All right. So why is development harder today than it was? So 4 things. The NOI, the numerator of the yield on costs, there's pressure there, which we'll go into. The construction costs have all gone up. The rising interest rates, and then obviously cap rate expansion, which we'll go into. So it's a combination of the numerator being flat on the yield on costs and the denominator going up, squeezing margins. Go to the next slide. So here's a rent and operating expense slide. So this is the top line NOI revenue that we're talking about. You could see coming out of COVID and record rates, rent growth was popping. It was looking good for everybody. That NOI was going to be higher going forward, and everybody was excited. You had record low interest rates, so development was very easy. As things have progressed, you see rent declining in the operating side with the property income going up. All that to say, the NOI is basically staying flat. There's not a lot of NOI growth, okay? If you go to the next slide, we're going to talk about the denominator effect.
Sorry, just want to go through, like, I see your sources. I think those sources are, like, trying to look into, they were national.
Yeah, this is very high
So
level.
you're like,
This is high level. This isn't specific to Narberth or anything. This is just why development's hard to get done today.
does the planning commission have Narberth related data like this?
We
I know it's
don't.
a small sample, but like it would be really interesting to see how rents may or may not have popped. I don't know.
The best, we don't, to answer your question,
Yeah.
you know, CoStar, there's third-party data services that have some of this. When I looked into the rent comps, which we'll cover, CoStar just basically does a Philadelphia MSA of the average expenses. So they don't even go into the property by property level. There might be, it would be probably more national if anybody's sort of tracking it, research desk, et cetera. But yeah, but this is national. These are just national trends.
But which is all fine. I just wonder, like, you know, you see these things from realtors where they say things like, you know, Narberth prices are now starting to compete with Gladwin, and that, you know, I don't know much about Gladwin, but I know it's higher than here, and I'm just trying to think of like how all that relates and what you all been able to divine as you make these decisions.
Yeah. We haven't drilled down into, you know, individual operating expenses. I mean, you almost have to get them from the developer.
Yeah.
They're not, you know, it's not publicly out there. So,
Fair enough.
that's a good question.
I did see, Dana, just to that point, some of these reference at least metropolitan area markets. So
Yeah, this is,
Philadelphia actually was, you know, had lower, had a very high occupancy rate for apartments, 95% or something like that above the national average, low vacancy rates, and had higher growth rental rates than the national average. I think it was, I can't remember, it was one of those reports that was cited on the slide, either 8, 4, or 7, one of those.
yeah, sorry, some of the citing, I threw this fairly together pretty quickly, but,
We don't think it is a national.
but it's just a national.
Yeah.
Yeah, but I mean, like and a low vacancy rate, high occupancy rate, right, itself is an indicator of demand outstripping supply.
Well, and that helps the top line rent.
Right.
This is showing that operating expenses are eating into the rent. So think about insurance, G&A, labor costs, You just have employees at the management office, et cetera. So the operating expenses are eating into the nationally what's happening. So the numerator of yield on cost is stable. Next slide, Megan. Here's construction costs. Again, this is sort of national data that I was able to get through the internet, basically. But pretty obvious: inflation, tariffs, you name it, construction costs, lack of labor. All the construction costs are going up. And what the point is on this one, in addition to that, you have operating soft costs and financing costs that get added. You've got the land.
Your call has been forwarded to voicemail. Hello?
Hey, Carol Rose.
Yeah.
It's Judy Giuliani. I'm just calling to tell you to disregard my previous message.
Hey, Judy, we can hear you. We can hear you.
I think the previous slide is a positive contributor to the top line.
Yes.
This is a
Denominator.
negative
Yep.
contributor.
Yep, exactly.
Yeah.
Exactly. So I've got a developer with a construction deal now, and I mean, their all-in basis is going to be about 400 a foot, right? So, you're in that 350 to 400K unit to build new. It's obviously much lower, 3 years ago. So just the point, construction costs rising. Next slide, please. Interest rates, we're in a zero interest rate environment. Now the Fed hiked, the fastest, I think this is the fastest they've done in a short period of time. So you have interest rates that spiked. I think the Treasury was 1.5%, now it's 4.5%. All this does is the interest for the construction loan is higher, which is adding to the cost. So it's the denominator that's going up. That yield on cost is compressing. Okay. Next slide, please.
How sensitive are the construction interest rates to the Fed rate?
Very sensitive. So everything's based off SOFR, which is a short-term borrowing rate, and all the banks, everybody prices off SOFR, or they're pricing off the Treasury.
So, if interest rates come down, say, there was that earlier slide where you had sort of 4 quadrants, but I assume that those aren't equal weight. So I guess how interest rate sensitive are the overall costs to the equation?
They're very sensitive, and it kind of goes back to Dana's question that the cap rate is sensitive to interest rates. So if interest rates were to come down, the interest rate for the construction loan comes down, less costs needed to build it, and your yield on cost improves, right? So all being, but that's what's happened. This is what's happened over the last 4 years. So we had virtually zero interest rates, and now we have much higher interest rates than what we had. Historically, they're in line with the 40, 50-year average. Treasuries bounce around 4 to 40%. So, but it's kind of shocked the real estate industry.
Is that, you mentioned that, what was the historic range?
The Treasury, I have this slide somewhere for a research slide, but it's generally about 4%, the average. If you look at over the 50-year history of the U.S. Treasury, we got into a cycle where everything went down, and all else being equal, that pops asset values, right? Stock market, real estate, very sensitive to interest rates.
So it was the shock of coming up from what was an abnormally low level.
Correct. Yep. Next slide.
This is the next slide.
Cap rates. Yeah. So perfect dovetail. So interest rates went higher. The risk premium, the cap rate went higher. I can buy a Treasury tomorrow for 4.5. If I'm going to buy a real estate deal, it's going to be 5.5, right? So what does that do to values? So values back in 2001 were 4 and a 4.5 cap rate. Okay, now they're 5.5, mostly because of interest rates. But that is about a 15 to 20% haircut in value. Okay, it's important. If I'm going to build something, I've got to build it. It's going to be worth more than the cost. Right? Go back to that theme. Okay, so now we've got a market where the values are lower. all else being equal, because the cap rate's higher. That make sense? Making sense? Okay. So you've had, in summary, you've really had a triple effect. You got the NOI flatlining, you got costs going up, you got interest rates going up, which is taking cost ups. You got cap rates going up, which is taking values down. Okay, this is why it's hard to get development done today. I don't love this slide, frankly, but it's just honing. It's just basically, you might hear the expression positive leverage, negative leverage. Again, leverage amplifies equity returns. So when construction loans or when interest rates are low, then it helps the equity returns. It's positive leverage. When they're higher than the yield, in the cap rate, or the higher than yield on cost, it's negative leverage. It's really hard to get out of negative leverage and make your equity returns work. That's why the market has been stalled. So investment sale volumes are down about 40 to 50% over the last 2 years because we've been in a negative leverage environment, meaning the loan, even if it's a value add property, the loan has been higher in interest rate than the cap rate. Okay, so what that does, it's harder for equity to get the returns. The market's sales volume's kind of stalled. Development's kind of stalled, right? It's just all correlated. So hopefully that makes some sense. Try to explain the best I can, but that's just sort of the factors of why it's harder, what's going on, just to give you a little example. So, all right, now we'll go to example. We'll do a couple things. This is, again, I said this at the beginning of the meeting, this is just my example. Being in the real estate industry, know what I know. I've not seen anything performance-wise, etc. This is just me doing the example. Then we're going to talk about how density helps boost that yield on cost. It helps make it feasible, makes the deal feasible. And then we're going to talk about the addition of inclusionary housing having, some workforce housing component and what that does to the yield on cost. Okay, so let's jump into it. All right, here's the setup. It's a 40-unit property, 75% one bedrooms. The rest 2 bedrooms. I just put 4 stories in there for the heck of it. It could be 3 stories. It doesn't matter. So the land cost, this is basically what the market value is today. I can pull sales comps from the city, the suburbs, but you're kind of at 35 to 50K a unit. I put 45 in just to be a nice round number. The hard cost, I think it was 267 a unit. The soft cost, I'm probably frankly a little light on this. This is about 20% of the overall development. I've seen it 25 and 30. And then going into that NOI, which we're going to jump into, I've got rent comps to support the rents that I've used. They're Narberth rent comps. I use a 30% operating expense margin, very common in the industry. If you're below that, you start getting questions. For a deal this size, it could be a little higher, frankly. But all that being said, in this example, it returns a 6.6 yield on cost. Okay, the cap rate's 5.5, yield on cost 6.6, 110 basis points of development spread premium. Really tight. This deal probably won't work today. Okay, it needs a little bit more yield on cost to make this development deal work. In this example, the equity will very likely demand more spread. Okay. Next slide. So I'm not making numbers up. Here are the rent comps that I pulled off CoStar website, etc. Average 1 bedroom in Narberth is about $2,500. Average 2 bedroom is about $4,000. It's $335 a foot. These are the rents in Narberth. This is what is this? The Elm. Narberth Square is the one on Montgomery. Maybrook's behind us. Lofts at Narberth Station. I think that's the Little Gym and the stations are right. So all fairly new. These are the rents. Okay, so this is where the revenues come from. Next slide. So here's the example on a 4-story. This is the same one on the left. If if you look at the bottom, it's going to generate that 6.6. Okay. The land's 45K a unit. The cost for what we use came in at 400K a unit. I may be light. I don't know. But it's my best guess. Here's the revenue assumption, right? We use those rents, 5% vacancy, 30% OpEx. We got an NOI $1 million over the cost, 6.6 yield on cost. If I sold it at a 5 cap, I would make some money, 5.5 cap, but it's probably too thin to attract equity, friends and family otherwise, to this deal. Okay.
So, quick one on the rent page.
Yep.
Are those the asked rents or the signed lease rents?
Asking rents.
Asked.
There could be concessions. They could be, 5-8% off.
I ask because my understanding is that the ask rent is, as I understand, I don't have validation of it. The ask rent is much higher than the signed lease rent.
Yeah, there's typically, depends on the market, and if the occupancy's high, the demand's high, you might get close to that asking rent and at a discount, called concessions. But often you'll get a half month free month. And it's a great point because the market underwrites to effective rents. So that's the actual signed leases.
Yeah.
This is asking rents. So this might even be a little high, okay? But to the left, using these asking rents, assumptions below are at 6.6. Here's what happens when you add 10 units, okay? On the right side. For this analysis, I presume the 10 units is going up a story. In real life, it could go wherever it can on the land, right? Or however they design it. But this is an addition of 10 units. So,
Can I ask you a question on that point?
Sure.
Does it change the cost if it's spread out rather than up?
Great. That's a good question. I don't know the answer to that because I'm not a cost guy. So, there is a breaking point where once you get...
I can chime in.
Oh.
You got Jen.
Thanks, Jen.
All right. So in my experience with our clients, there's a number of stories. So typically once you cross out of the threshold of being able to just do wood stud construction, which is 4 stories, unless you do a different sprinkler system, 5 stories with a commercial podium, which a lot of the properties that have a commercial ground floor and then residential above are doing steel on the ground floor for the fire rating, and then 4 stories of wood. Once you try to cross over that, that's when the costs change dramatically. So there is a cost differential if you don't have commercial on the ground floor because you don't need that high separation between business and residential. But then, that sort of 4 stories of lumber is that threshold that we see where costs start shifting, either because you have to do a more intense sprinkler system or you have to change your construction materials out of wood.
And that's 4 stories of lumber.
Of lumber,
you could do
yeah.
that on
So
top of the
when
podium.
correct. So you can do 4 stories of lumber on top of 1 story of steel. There's a allowance in the building code for that in order to allow for, and actually you can do it 2 stories of steel and then 4 stories of lumber, in order to have the required fire separation between commercial and residential. So most new construction that are mixed use have a steel built podium is what they call it, and then you build wood on top. So 4 stories of wood.
So if it was 4 stories on a podium, you're talking about a 5-story building.
Correct.
So wait, so just so I'm clear, I guess my question was whether there would be a difference to the builder if he went, 4 stories on a broader footprint versus 5 stories on smaller.
There's sort of a factor, but typically the more foundations that you have to do and the more under slab utilities you have to run, the more expensive the cost is. So it's cheaper to go vertical than it is to go horizontal.
Yes, thank you, Jen. But to Jen's point, there becomes a point when you go too high, and then you got to get all steel involved, and then it becomes very expensive, right? And you need much higher rents to justify that. So that's typically the city, for example. And the city will allow that. So, but thank you, Jen. So five. Okay, so we're going on 5-story examples. So now we have 10 additional units. Hypothetically, this is 5-story. The land is a fixed cost, right? We already had the land. The developer had the land at same price, same cost. Now it gets spread over more units, so that cost comes down on a per unit basis. There's synergies in the hard cost construction. There's synergies in the soft cost, all the financing, the architects, engineers that go into it. And there's also synergies in the net operating income. It's the property level. You've got more units, more revenue, and now your expenses can come down a little bit because you've got fixed payroll, fixed marketing for the most part, but there's stuff on the margin that kind of changes, okay? So again, this is a hypothetical example, but here, now we go from a 6.6 to a 7 yield on costs, and this is feasible in today's market. Make sense?
If you had like a 1% drop in interest rates, I mean, interest rate tends to be 50 to 70% of cap rate.
Yeah, I think I would argue that's probably about right. Yeah.
So if you had, so let's just use that as like a proxy for cap rate.
Mm-hmm.
If you had a 1% drop in interest rate, how much more profit would the developer make?
This is a little bit of a loaded question. It ultimately depends on that cap rate. So if all of a sudden you went from a 5.5 cap to a 4.5 cap.
My calculation got it to about 50% more.
Yeah, you pay the debt and then, I mean, I don't know, it's probably something like that, right?
About 50%.
Because the debt's fixed, right? So.
The reason I ask is I don't doubt the math. You got the right, divide this by that, get the right number. I think it's the assumptions going in. If you look at your interest rate chart, it kind of goes like this, right? Mm-hmm. Well, if it keeps going up, then no one's going to build anything. But if it drops down, everybody's going to be swarming the land. And I want to make sure that the math doesn't drive policy decision unless it really has to. And I would offer it doesn't need to. But my suggestion here is that 1% in interest rate drop would yield about 50% more profit for a developer. And I think you're saying it feels in the range.
It's definitely more.
Without your calculator.
Yeah, it's definitely more. I think I had an example here where it was 4.5 and a 5.5 cap, and it was, it was about an 18% difference in the value of property. When you take out the debt, which is paid first, then on the equity, it's going to be higher, right?
A lot higher, yeah.
It's going to be higher. But again, on the interest rate, people are actually forecasting a rate hike. And historically, that treasury has been in that 4% range. So yes, it's hard to say with certainty that where rates are going.
But
right,
my thought is that, and this is, you're in the business, I'm sitting here. My thought is that if the rates continue to go up, probably not going to get a developer to bite on that anyway.
No.
It's going to have to go down. So my thought, again, I'm not the expert, but we need to model scenarios where the rates drop and show what that profit is.
Okay. Yeah,
just a thought. Which to me, sorry.
Yeah, no,
I don't know.
I'm sort of going back to the chart on the cap
Give me 1 second. I don't know the rule about deliberating or not. So if I cross into that, just let me know. Okay.
Yeah, you're good.
My advice to council in support of what Aaron's saying, because it seems good, is that if you're jumping from math to zoning policy, just remember that if the rates keep going up, it's unlikely you're going to get development on that spot. So you could build 5, 6, 7 floors, whatever, probably not going to pencil as well as you think. But when the rates drop, you're going to have developers clamoring to get at that property because it is what they want. So it's just have that in mind as you think about 4 and 5. I would offer we're headed to an environment where you're not going to get development on that. So,
and it may be right that, like Aaron was saying, that every property is different depending on when
This is in the hypothetical
It's a
property.
hypothetical.
Yeah.
It's intended to illustrate the different things that are going into someone's thinking on the other side of the equation.
Yep.
So we understand that.
Yep.
Since council members have specifically requested the desire to understand some of them.
Yes,
I
that's
think
what I'm
the
trying
thing
to.
is,
Oh,
going back is to my thought about interest rates too, because when I read some of the reports that you put out, this seems to presume sort of current conditions.
Mhm.
I feel like.
Yep.
When I was reading some of the reports that you put out, and I'm going to disclose something sort of embarrassing here, but one of those is Arbor Realty Trust, and I actually am an investor in that company, so I get their annual reports, and in general, they have been, and I've watched the stock price go significantly down from some of these challenges, but their reports, including the one that you've included, have suggested that market conditions are sort of turning for the better, and they're modestly optimistic for the coming years. And so I'm trying to think of this, in terms of the zoning and policy side of sort of long term, not what we need to pass to have a apartment building built today, if that makes sense. So that's where I'm struggling a little bit, and that's why I keep asking about changes in the interest rates, because I'm trying to figure out, if I had a spreadsheet and put these variables in, how much the math changes over time.
I'm sure I can find something that has the average cap rate for multifamily over a longer period of time. Mm-hmm. I would argue that we were in the lowest of low environments back in 2021, and I don't think we're ever getting there, at least not for a while. And by the way, if we do get there, the world's crashing and the Fed has to cut rates, right? So it's bad. But I'm sure I can find something research-wise that has the average multifamily cap rate. And I think what that would tell you is it's historically been closer to a 5 to 5.5. Okay.
But if I look at 2019 on your chart, it's somewhere between 5 and 5.5. I don't know what's before that. And now we're at, first quarter of 2026, we're well over 5.5. So in some ways, we may be artificially high.
Maybe a skosh. I would think historically multifamily's been around the 5.5. The average treasury has been 4, over the course of 50 years. So Dan, to your point, if interest rates drop tomorrow, cap rate should come down to some extent. But do they ever drop to where they were? I highly doubt it. So that's my opinion.
And also to clarify as well, because it's come up a couple times, the development economics is not the why for any of these things, right? We've been discussing the why at our council meetings as a governing body. And this is to give us some sort of baseline understanding of the dynamics that can answer if we believe that adding housing is generally good, and all the other things we've been discussing in our council meetings, then understanding how housing actually gets produced in the real world is wrong.
Yep. Thank you, Mike. All right, so a lot going on here, but this is the trade-off equation. We call this the incremental yield on cost. So in this example, building more units gave us more top-line revenue. It helped reduce our operating expense ratio. NOIs improved. The costs were spread out. All the fixed costs were spread out. So it's the land, soft costs, financing costs, the hard costs, etc. And that difference produced a 9.4 yield on cost. In this example, all hypothetical, right? So this would say to the developer, yes, it makes sense to build this extra 10 units. Okay, that's how they think about things. That 9.4 incremental cost took that 6.6 yield on cost now to a 7. Okay, makes it feasible. Hypothetical example, but this is how they think about it, okay? Now we're gonna jump into the next example where we've given them 10 units, but now we're gonna say, hey, we want 10% of those units to be 80% AMI, workforce housing. So now we're gonna go through that example, show what that is. Okay, so here we go. Same setup. 5 stories, 50 units. I'm just using 5 stories as an example, but 10 more units than what we had. Deal pencils. Now we go and say, okay, in exchange for giving you those 10 extra units, we want 10% of those units set aside for workforce housing. Okay? So you see at the bottom, nothing's changed. The costs haven't changed, etc. They've changed. No, they haven't changed. Yeah, because it's the same cost. What's changed is the top line revenue number. So now all of a sudden, instead of 5 units at $26.50 rents, we have 5 units at $18.50 rents. Okay, we lost a little NOI. That's going to take us. We went to 6.6, we went to 7. Now we're down to 6.77 or 6.75. Based on what we're seeing now, that's in the zone of being feasible to raise enough premium there to raise it and deal gets done. If you go to the next slide, here's the math on it. Here's the incremental, okay? So the developer just ran an incremental yield on cost and said, okay, if I get another story, now I got a 9.4 incremental, and the yield goes to 7. And now, if you're telling me I need to put 10% of those units to be workforce housing, the incremental goes to 7.8, okay? It's still better than what it was, 6.7, so it still adds to the deal. So now we have a 6.75 yield on cost, right? And now you're still in the feasibility zone, okay? But that's how I think about it. It could be workforce housing. It could be, let's take a little parking away, particularly structured parking, very expensive. It doesn't add hardly much revenue. But those are the trade-offs that the developers are doing in their head, okay? They're working with architects, engineers to try to design the most efficient building and figure out the unit mix. And these are the calculations that they're doing. And ultimately, they want that yield cost, right? Okay.
I think what I heard you say was more than likely interest rates will go up. But let's go on that for a minute,
Okay.
right?
Yep.
Because I think you said it's highly unlikely that they go back down. It makes all the numbers look better. I'm trying to think how I want to ask that. Because does this still pencil if we go from 5.5 to 6.5? I don't think
Interest
so.
rates?
Yeah,
Yeah, no, this doesn't pencil at all.
I don't think it does.
No, because it's barely penciling now.
That's what I'm getting
Right.
at, yeah.
So this is,
Again, we're talking about math.
Yep.
Just to understand.
Yep.
Because I think a lot of the discussions I've been in with the group are the 5th floor is a really great thing. And it's like kind of glows in talks. And I just want to make sure I understand what you're telling me from the math that maybe not.
Maybe they're not. And I don't know, we don't know the land basis of the developer has, right?
Okay.
Yeah.
So, and this is my guess on what the construction costs are.
Yeah.
Very educated guess, but
Can I ask another question in that regard?
sure.
You said it at the very end, so parking becomes an issue, particularly if it's garage parking, right? So, how, and I assume that this kind of presumes built-in parking in your numbers?
Just nothing structure garage-wise or anything like that. Just basically, 40 units and what we're kind of seeing costs come in at. But yeah, there would be like surface parking in this example.
Well, so I'm trying to figure out whether your hypothetical presumes garage parking or not, because I think that probably makes a pretty significant cost difference. So if I'm looking at,
and I stripped the parking out.
We haven't talked about particulars, but if we're talking about the most likely place that's going to get built here, there's not going to be a parking garage because they have adequate parking on their surface parking. So I assume that's going to bring the cost down, but I guess can you get a sense of whether that reduces overall costs? as a percentage of, say, on a 40 unit building?
Parking garage is hard to say. Depends on how many levels and stories and all that. But I just excluded it out of this. So there's no parking revenue. There's no parking really associated with this cost wise.
Your cost for construction also was not including a parking garage.
Yeah.
Well, that's what I'm saying is, if we're presuming cost of construction here, Jen, are we presuming parking is part of it or not?
No,
Yeah.
no.
Okay, that's.
The problem is parking has a lower.
The cost of a parking garage is about $100,000 per space at the moment.
Right, I know, it's very expensive.
Yeah. This does not.
That does not. The 238-ish number that you had in there per unit for cost of construction is just, that's the average rate we're seeing with a property without a parking garage.
Okay, that's what I want. Great, thanks.
Yeah. Thanks, Jen.
Sorry, this might be for council. I don't know who should answer this, but when we do a 5th floor with 10% workforce housing, how many workforce people is that going to bring?
Per unit?
Per unit, I mean, like the.
Well, in
Depends
this,
on
like, you know, the
It's
developer
4
would take
units is
160 basis points of hit, and he's going to bring how many workforce individuals to the area?
You'd be required to rent 5 of the units, so it could be
5 to 10
5 or
people.
above, right? Yeah.
Okay.
Yeah, it's 10% of the
It
units.
depends whether it's one bedroom or 2 bedrooms. When you talk about percentage of units for workforce housing, is it a prorate, like can it just be all 1 bedroom apartments if you have a mix of 1 or 2, or is it typically like you prorate, if you have 30 2 bedrooms, you should have 3 2 bedrooms and 2 1 bedrooms, or?
It's a great question. I don't know the answer to it.
Okay. Maybe
We
to
have
decide
not-
that from a zoning perspective.
Our conversations regarding the bonus have not dialed in on if that should stipulate a percentage of each
Yeah.
apartment type,
Okay.
or if there's a preferred apartment type. We've just been the recommendations that Planning Commission has forwarded is just 10% of the number of apartments.
Would these analyses hold if we were gonna stipulate a certain percentage of each apartment type?
Yeah, I mean, usually I've seen whatever the unit mix is, 1 bedroom, 2 bedroom, and you know, in this case it's 5. I just picked 5 1 bedrooms because it was, you know, low rent, easy math. But yeah, I mean, maybe there's 25% 2 bedrooms in this example, so you know, 10% of that would be 2.5 units, right? So like I think there's some of that.
So that's a reasonable ask.
Yeah, no, I don't think it's.
Okay.
I think it's unreasonable. But I think it'll just kind of case by case.
Sorry, just real, I lost a number. So what was the NOI for 4 floors in the model?
Go back to the slide, the 4 and the 5. I think it was around $1 million. Yep. Then we went to $1.3 million with the 5-story. And then Maggie, go back down with the NOI with the affordable housing. One more. $1.2 million. We lost $50K of NOI. Yeah, there's the map. We were at 256 incremental NOI. We lost 45,000.
But that was 256 for adding a 5th floor,
Yep.
and then 44,000 is the loss if we require 10%.
In this example, yeah.
So it's
Right on.
they get 300,000 for adding the 5th. They lose 44,000 if we get 5 to 10-ish workforce people moving in.
Yep.
And there's a lot of risk in that number because 160 point loss on this assumes the 5.5. Highly likely the interest rates would go up and would kind of crush that number.
Yeah, if I knew where interest rates were going, I would not be here and I would be retired.
I think
But
with
yes,
something like
you're
this,
thinking about it the right way.
Okay.
Yeah, I'm not trying to be tongue in cheek, but
I appreciate the bank humor.
but yeah, so the point of all this is we give them the bonus comes in, the density, what I call the density bonus, you get 10 extra units. But we're going to require, in this case, 5 units, half of those, 10% of the total. The incremental NOI loss comes down a little bit. The incremental yield on cost comes down, 9.4 to 7.8. But all in all, the developer probably takes this deal in this example if they hit that 6.75. Okay.
It's a major risk point, though. Council, I know I've said it 100 times, but we should make sure it's a pretty major risk point. If you have 1%, again, I'm doing stuff real fast on the calculator, so it's before 1% interest rate change with a 50 to 70% impact on cap rate, the developer loses 20 to 30% of their profit just off that. So they're going to look at that and go, I don't know. Then if you have workforce on top of that, it's going to be those are going to be viewed as negative incentives.
Yeah, for sure.
That's why, to go back to the very beginning of the slide, why we start off with a premium for real estate development, the return premium. Okay.
Yeah, your math is great. I think sometimes we look at numbers, see good numbers, and say, okay, let's make a policy around that. I just want to make sure we're not. I know Michael said we're not, but let's just make sure. It's okay.
Next slide.
Yeah, because I think probably the concerns that we've heard relating to size of building, the concerns I feel like probably mostly don't come from a place of, hey, this might not happen. Right. The concerns are usually on the other end of the law.
Yep. Again, this is just the math. This is how developers think about it, right? So I will continue to say that each deal it's going to pencil a little differently than the other one.
I kind of quibble with that a little bit. I mean, we do hear from a lot of people who would like something like this to happen.
And you're right.
We would like to craft a policy. I mean, I only speak for myself from what I heard, from the goals of council and from what some, the people who see the benefit of workforce housing, affordable housing. It's incumbent on us to craft a policy that is effective,
Yeah, you're right. I was doing what I criticized for, which is overgeneralizing and zooming in on one specific subject.
I mean, that's what we're doing here. I think, right? I think it is.
Yeah.
Okay.
I think the goal is to get to desired policy outcomes, and everything else is the mechanics around how can we accomplish those policies. That's just the way I see it.
All right. Okay. Well, that's probably a good segue. So, sorry, Maggie, one more. Yep. So, I was asked how much workforce housing is the right amount. We just went through the example. In that case, it made that deal, I think, pencil. In other cases, it may not. Dana's point, basis, rates. The whole point of this is just to show you how sensitive real estate development really is and how much factors go into it. There's not a simple answer, I don't think, personally. What I can tell you is the city of Philadelphia has an inclusionary policy, 10%, 60% of AMI, so lower incomes. To me, that generally makes sense because I think the incomes in the city are probably lower than here, all else being equal. They have a payment in lieu program where a developer can bypass that requirement and pay the city a fee, right? And they can use that money to help support their affordable housing causes elsewhere. And I was trying to research this fairly quickly, but I found a website, Legal Clarity, that had a pretty good write-up on it. And generally speaking, their research suggests about 10 to 20% is sort of the right mix to get a density bonus. Anywhere that 10 to 20% seems to be the most common. It also happens to say in there, and put that the parking requirement tends to go down 10 to 20% as well. because sometimes to get higher density, you have to change the construction costs, you have to add structured parking, and that parking really kills the cost, the yield on cost, right? So there's just some couple data points that, to think about, to noodle on. But, in this example, the 10% was a magic number. If we had done more, it would be below that 6.75 yield, and I don't think we would get done today. So.
And I think your third point on here, which is that voluntary programs are calibrated. We probably don't know this off the top of your head. My understanding is that in a portion of West Philadelphia, they created a 20% mandatory set aside. And my understanding is that housing construction basically stalled in that specific portion of the city after that was adopted. I don't know if you're familiar with that.
Vaguely, probably not as familiar as you are, but yeah, I have heard that. So, which is another good segue. We'll go to the next slide. So, I did a presentation at ULI talking about similar topic actually, and so this is one of the slides that I had used there. These are just some of the tools when you get into the affordable housing, the workforce housing that are available, federal, state, county, and then you've got your private capital out there, ESG investors that'll take a lower return, knowing they're doing good. They're hitting their ESG goals, I should say, I guess. So there's other things out there. You've got the federal stuff, which is mostly the LIHTC, they're the low income housing tax credits. You get the opportunity zones, you got Section 8, right? That's really more intended for levels 60% AMI and lower. So much lower incomes, you really need some subsidies to make that math work, right? And so that's that level. The most common we've seen is just, is these state tools. It's tax abatement. So, you're hitting the revenue a little bit on the rents, but you're giving it back on the OpEx, lower taxes, right? I don't know how all that works with us and Montgomery and the schools and all that stuff, but counties typically do that for states, right?
Can you just, before I try to jump in, on the federal side, the federal bill that got passed that may or may not get signed, and you have it on here, the pending legislation. I haven't had a chance to really figure out what's in there, but could that, do you know whether there's stuff in there that can make this building, like, is there low market?
I haven't done a lot of research.
And stuff like that.
I've done a lot of research in that department, Mike. It's a great question. I think it's still a little bit more at the federal level in terms of subsidies and LIHTC and trying to expedite permitting and.
Everybody seems to think it's the greatest thing since sliced bread. It's kickstart the housing market. But I haven't seen any particulars to figure out whether we can take advantage of that somehow.
I don't know the answer to that. That's a whole other research topic.
Look into it, because I don't want to speak out of turn, but I've gone through it a bit, and I'm not going to speak on specifics, so I'm not super conversant, but it does do changes to some of the federal programs. And I believe that part of the goal is to make some of the funding more flexible, where it might be more difficult to use it for X or Y to allow to hope increase feasibility. And also this is not going to affect us, but it incentivizes folks that are recipients of the community development block grant to actually add housing. So communities that are those recipients that add housing will see the funding that they receive through that go up, and communities that do not add housing will be penalized to align incentives to towards actual on the ground outcomes in terms of who's adding housing, who's not.
And that doesn't apply to us because we don't have.
Because we're not a community development block grant recipient. But for us, kind of one of the, not that this would have huge effect, but there is direction for the federal government to produce best practices for state governments and for local governments related to zoning for state governments in terms of what powers they give us or decide not to give us, and for local governments in terms of what we're doing or not doing.
Thanks, Mike. And then here's just some stuff that at the bottom, local municipalities have a little bit in their control and can manage, right? And that's the permitting process, it's trying to expedite that to some degree. Just a lot of soft cost money sunk into getting zoning and entitlements done. General density, the ADUs, townhomes, parking reductions from a cost perspective. And then again, the inclusionary zoning, which is the 80% AMI that we just talked about. Hopefully this was informative. That was the goal.
Can I ask some big
Sure.
picture questions? I just want to make sure I understand that, what you put up here is sort of just a hypothetical, not based on necessarily what could or would be built in Norwest.
Correct.
And sort of related to that is, and maybe this is off topic, but I think of the I'm thinking about the fifth story. It's because we think it's necessary, from my perspective, it has to be necessary to get the kind of development that we want. And what I maybe don't understand is why we have different standards between 4A and 5B in that regard. Because 4A, if we're going to allow for increased density, we're going to allow to go to 4 stories and 45 feet, which I think presumes that that's feasible or we wouldn't bother. But in 5B, we're going to 5 stories and higher to do the same thing. So why is it just sort of the difference in the feel of the property you're trying to keep it, or because if 4A, if you can build 4 stories, 45 feet in an apartment with affordable housing in 4A, why shouldn't the same standard apply in 5B? Like, why did the planning commission decide to come up with 2 different?
It's a good question. I'll just answer by having myself. If Jen's still on, she can answer. But I think the thought for Montgomery and the 5B was a little bit more of a commercial feel to it versus 4A, which is, down pretty much next to downtown, and going to that 5th story. I personally, I don't. I guess the answer is we don't really know the answer because we haven't seen the pro formas as a developer. I haven't, but I think it's a little bit of look and feel, character, and art to some extent.
And it's pretty normal, right, for communities to zone more intensely in their usually in their downtowns and on their commercial corridors.
Yeah. Well, but I'm trying to get to not what, but why. So it's more about the aesthetics than the economics.
Yeah, in my opinion, yeah.
Yeah, and 4A, I don't know if this makes a big difference, but 4A has no first floor commercial that I know of, right? It's entirely residential. Is that right?
But we've really limited, we're changing that 5B to allow for residential on the ground floor almost entirely.
No, but
If we do that.
well, but I think Jim's point is that 5B is a mixed use zone. Even under what we're contemplating, it is still a mixed use zone. 4A is effectively a residential zone that has certain hyper specific regulations that allow for a mix of uses in a tiny number of circumstances that are probably not going to occur for the most part. So there's a difference in terms of those districts, but I think and now we're getting to the core of zoning. All of zoning is dividing up portions of your community and then trying to figure out what you're comfortable with where. So that's just kind of inherent in the discussion.
Sorry, it's not my meeting, but
Yeah,
I'm
it
here.
is.
These are policy things.
Yeah.
Right.
He's presenting the financial case from the eyes of a developer, and I would just caution you all to pull those apart. I mean, we didn't talk about the jobs report. Job support, what does it do? Job supports that are bad will tell a bank to not, will tell the Federal Open Market Committee to keep interest rates lower because they want to keep the money flowing. But if the job report, goes too high, I mean, correct if I'm wrong, you're the banker here. The job reports go too high, they're going to tighten it up, and if it tightens up, then that deal, every deal you put on that board falls apart. Sorry to.
Just mean it becomes infeasible.
You can't do it
Yeah.
because the way you tighten the market is to raise interest rates.
Yeah.
And if you raise them, one percentage point of raising, which they don't do 1%, they do quarter, half, that kind of range. But when they do that, you can very quickly get there. So just separate as much as you can the financials of what a developer looks like from what you want from policy.
Totally.
And remember that economic policy we haven't even really discussed economic policy here, which is a big issue with what I hear you starting to go into compared to what he's talking about.
Totally, and I think these things are different, but I think that one of the reasons we're having this is because it was requested, but then also one of the other things is it's come up before, right, in terms of the question of, well, what if we set the density bonus at a completely different level of height? What would that do? And I think that like the relevant piece to us is to say, what are the policy outcomes we want? A. And then knowing that we don't have like a button that will just produce them, trying to figure our way through if a affordability set aside is something that we want to pursue as a policy outcome, how do we position ourselves in a way where we're never going to be guaranteed that it is necessarily feasible, but how do we avoid the use case where we just make everything, we're pretty sure everything's not going to work.
Or they'll never take the incentive. That's my, we talked about that a little bit, Lower Marion didn't quite, they didn't get the incentive because it wasn't good enough incentive. They changed it to increase the incentive, but, we have to figure out a little bit and sort of silly to have an affordability incentive that nobody's ever going to invoke because it doesn't make it.
Point.
Yeah.
I mean, half a
better.
percentage point, right? So,
Yep.
again, this is on public record. People are going to test my in my head math, right? So fine. I mean, Aaron, maybe you can give a head nod. That sounds right or not, based on what you know. But I believe a half a percentage point on that model with 10% workforce housing. Again, everyone is different. Would make it so it wouldn't happen. I think that's correct.
Yeah. And so like
So a quarter, which is what is which is what's projected for the fourth quarter of this year, 40 percentage point increase is going to make it, pretty like the developers are going to be like, I don't know about that. Maybe I'm building a car wash.
Yeah.
Because those
it'll make it tighter, but it's hard. It's hard to say where that cap rate would be, right?
And I think that
based again on like 50 to 70%.
Yeah, cap rate still may hang in there. It's just, but yeah, it's very, very sensitive.
Yeah.
But that's the whole point of this. It's all
really good. So, because I think that a lot of what we've discussed, right, is how do we try to create housing, right? We have a community that's mostly covered by a historic district, which makes it more important for us to try to actually plan for these things. And then we've discussed spreading land costs across more units where possible. And I think this doesn't say why we should do any of the things, right? It just demonstrates some of the underlying dynamics that are being encountered.
Sorry, I'm going to get all the vocabulary wrong, so sorry. But so assuming that there is an interest rate rise, which starts to put these things out of feasibility, right? And then we're just sort of coasting on, nothing will happen. Ultimately, when they start to lower again, will a developer be watching those numbers and like waiting for a certain level to sort of pounce on that? Or will they sort of hope, try to project a bottom in the future where they're like really gonna go all,
That's a great question. I mean, I think some developers are trying to get a shovel in the ground,
Yeah.
gambling that in 3 years from now or 4 years from now, when the property is built and stabilizes, that cap rate's going to be lower than 5.5, right? Others are taking the stance it's going to stay at 5.5, and again, it's very it's just very sensitive. So if rates come down, it does help the cost incrementally on the construction side from interest. The cap rates tend to maybe tighten a little bit. But again, I think I'll try to find some data, but I think that historical multifamily cap rate's probably been around 5.
So would it be reasonable? I mean, obviously, you can only make decisions like this based on the information we have now and the conditions we have now. Would it be reasonable to decide, with the numbers we have now, knowing that is going to fluctuate over time, and at some point they either won't, or they will, or they won't, or they will. You know what I mean? Like, we can't predict that, but over time, an opportunity is going to come up for someone.
But I think a couple of years ago it was oddly low.
Yeah.
So that 4%, we just kind of got to push that over here. It's more like in the 5 to 6. It's going to bounce in that 5 to 6 range.
Yeah.
And when it's 6, it's not going to work. When it's 5, they're scratching their heads like, I think I want to do it.
Yeah, right.
And then when you add the 10% workforce on there, they're like, well, maybe I'll build a car wash. Because that's a 30% return on average. If you're looking at returns and you have people you have to promise a return to, you start looking at things like self-storage and car wash and laundromats and, mobile home parks and, I'm not suggesting we authorize those. I'm just saying that you start looking at other things.
You just said a lot. Okay.
It's a very, very sensitive thing to that interest rate, cap rate.
Yeah.
Cap rate, mostly interest rate.
So we've only primarily been talking about multifamily housing. We haven't talked about the other things in the code, like smaller multi-unit housing, the twins, the quads, etc. And I don't know whether that was because you were specifically asked to talk about multi-family housing, but I had coffee with somebody a couple of weeks ago, and he was saying that actually and I was surprised by this, and it was counterintuitive, so I just want to ask you if you have a view of this. He's like, whatever you zone, basically if you have a plot and you give the person the opportunity to build single family housing or an apartment building, they're going to build single family housing. They're going to make more money off of single family housing than a multifamily unit. And that seemed counterintuitive to me because I would think that you generate more income off.
Did they say a higher return or more gross money?
No, they said that a developer would be more likely to want to build a single family house and get a bigger return.
Well, you have different developers, right? Like obviously different developers can do different things, but often the single family person is not the same as the other one. So potentially what the dynamic you might, and I don't know if this is the case or not, potentially what the dynamic might be is if, think about the timeline that Aaron laid out of an 8-year timeline and all of the uncertainty around that. Think about, he was talking about let
me take it out of the big apartment building. I actually was trying to go somewhere else, which is housing versus auxiliary housing units, because there was just something in the inquiry about how AHUs are actually this guy, people have not been really into it, and this builder was saying, actually I'm doing a lot and I can't keep up with the land.
I actually know him, and the problem that he runs into is that every municipality makes it incredibly difficult to build accessory dwelling units for various different reasons. So he's actually had to get into other sorts of business because of that key problem. But then also, when you go down that route, right, some of the easier things than forcing someone to build an entirely new structure, which I think we should allow, but some of the easier things are allowing people to turn your interior units into multiple units, like in an existing structure, but then you have to open up the discussion about parking, because if you have a given lot that is existing as it is, you then can't do that if you can't suddenly fit, 4 spaces or whatever the case is. So I think we should kind of have that discussion, but I think what we've seen in Narberth, right, is that there's examples all around us of things that in a very technical, theoretical sense have the ability to be like a triplex or something, and has not occurred. Right. In many, many instances. And I think that there's probably a number of reasons for that. But just in general, usually the easiest thing to do is when you go to do single family, obviously you have to subdivide. The subdivision comes to us if you're subdividing. But then after that, you're mostly just pulling permits. You're not coming to us with a land development. Whereas if you were to do, Maggie, I think this is correct. I'm going to pitch this over to you just to confirm. If you were to do a 3-unit, like a triplex, you have to go through land development for that?
You would, because it's more than 2 dwelling units on a lot. So if we take a look at our saldo and look at the definition of what constitutes land development, it should say, stand by.
Maybe
And
I
this
got too far off topic, but I was trying to figure out the economics in these other contexts. Like, do we have to think about how to make those things work economically as well?
Well, we
just
do, but I think that was part of their recommendations for 4A, right? And I think we're going back to them as well with, and this I think gets to your question of like, oh, well, why, what does the additional height mean in 4A? And to me, it means if we're talking about, for instance, the stacked town form, right? Then that, I believe, is a different construction type, right? It's probably cost better for the developer in terms of construction.
That was my question.
While also getting the additional units that allows you to spread out land costs. But again, it's all highly theoretical. All of this goes back to the same thing that the mayor was talking about earlier. But the point is that we know that in general, a dynamic is that the more density on the site, holding everything else equal, the better it's generally going to be. And the more you're also, for the stuff that I care about, the more you're spreading out those land costs across multiple units, which allows you to hit a different price point than you would otherwise be able to.
And it is a land development.
Okay.
So if you were to build a new building that has 3 residential dwelling units within the same building, it constitutes a land development. So you have to go through the land development process.
But could we change that as part of the zoning code? In other words, if that's
that's
cost barrier.
That's defined in the municipality's planning code, which is the state enabling legislation for zoning. So no.
But we do have, and I confirm this with Walker, we do have the authority under the MPC, even though we're not changing what it is, we have the authority to treat things differently. We have the authority, the MPC gives us the authority to say, well, we want to make certain things administrative and certain things go to council. Mm-hmm. So we could set a dividing line if we decided that projects below a certain threshold we wanted to be an administrative approval because we want to put them on a similar footing to just to a large footprint single family, and we could make that policy decision. We have been given the authority to do that under the MPC.
Okay, I feel like we should take advantage of this time for questions for Aaron while he's
Yes,
here. It's very valuable to have you here. I really appreciate it. I appreciate it.
I took us off on a little bit of a tangent, but I was just trying to generalize it away from the multifamily to all the other.
But also multifamily in and of itself is also an important housing type.
Right. No, but I was trying to generalize the economic discussion. Yeah. You have a better understanding for all of the new typologies that we're considering to make sure that Right, the economics, in theory, work for those too, right? Like,
Yeah, and it is interesting because to the point, like, for A, you actually have a palette of different options that you can choose from. So if the development economics do not work for
well,
multifamily, then one of the goals here is to make sure that we have a solid palette of missing middle, that you currently have only a small number of options. Montgomery Avenue has historically been in our comp plan as like a mixed use zone. So that one is much more, you actually don't have the same,
So, but that's what I was trying to say. When you have the palette, this is sort of what I related to last time in our last meeting, was like, when you have the palette, how do we incentivize, if we were to decide from a policy standpoint, how do we incentivize the more dense development over the single family house if they're all allowed in the same zoning code? And that's what I was trying to get to, is like, are there, does the economics mean that if I'm a builder and I'm gonna buy this plot, am I more likely to build a single family house, or am I gonna build a quad?
I think, because I think this will get us back, so you described soft cost earlier. Did you describe for us what goes into soft costs generally?
It's everything from all the architects, engineers, surveys, the third-party reports, the real estate taxes, the insurance, the carrying costs. And you've got the soft cost component, but the hard cost was, it's just overhead, project management, things like that. And you have the financing piece of that, which gets lumped into sometimes soft costs, but it's everything associated with a loan. So I can't speak to the ADUs and the economics there, but I mean, all else being equal, it's probably faster for those. It's a different type of developer, and it's probably faster for them to get in, get out, build it to sell it, right? Than a multifamily. So
and so that is a dynamic as well, right? So can you speak to in general? It sounds like the more certainty you have about process, and the more compressed you expect that timeline to be from.
Oh yeah, it's real, right?
I mean, expedited approvals is clearly something you want to look at.
Well, both expedited approvals and having a process that's predictable, and that that you're not necessarily going to be arbitrarily denied by a governing body.
Yep. I think it's really hard, it's my personal view, to design a policy around the what if scenario if rates go down or go up. I mean, it's inevitably going to happen over time, but I think that's for the market and the developer to manage that, if they're taking that risk or not. And it does spin things to, if I can't do this, I can maybe do X, Y, and Z, right? And that land value ultimately. So I think it's hard to design a policy around that. I think what I hope was this example was helpful, that as it stands today, I suspect it's hard to get development done without some sort of density. So
It's very useful.
For sure. One of the things we've got to make sure, so debating whether I want to go into it or not. This is no judgment on the presentation. It was very good. As you all consider whether people will start thinking about this, you got to remember, like, things you should be looking for in the news. Number one, what's the unemployment rate? It's actually kind of low right now. When it's low, that tends to put pressure on prices because people are buying stuff. When you put pressure on prices, you tend to raise the rates. And you all know all this, but the two goals of the FMOC are, number one, maximize employment, and natural unemployment, depends on where you got your MBA, is around 4.7 to 5 in that range. We're at 4.2. And, so it's maximize unemployment, number one, and number two, stabilize prices. We don't have stable prices in the US. So it would be odd if we had too many quarters without rates being raised. I'm not an economist, but that's my opinion.
Yeah.
Maybe you're the economist, I don't know.
Have you seen the Fed lately?
But the point of that would be,
Yeah.
if that happens,
Yeah.
the 10% bonus is less appetizing.
Yeah.
For sure.
Then you gotta think about the 5th floor, then you gotta think about all that stuff.
Yeah.
So just be careful when you're creating the policy in your mind of this model told us this without looking at what's going on. That's all I'm saying.
Yeah.
We could, and actually, I think this was, there's different, and you spoke to this a little bit. You mentioned how in Philly they have basically like a feed route, which is effectively your pressure valve in that case. But it's totally possible for us to build in pressure valve processes that.
I mean, boroughs can do tax abatements, it means less revenue at the front end while they're building, but, it does make it more affordable.
Yeah, I do tend to avoid that. I mean, like part of the whole like ecosystem thing.
I don't want to go there,
right,
but there
is
are
building the tax base as well.
Yeah.
Yeah.
Yeah. Well, it's funny. It's
Those would be temporary though.
those would be temporary, and in theory, you're going to make far more than the tax abatement's going to.
Yeah, more people living
Yeah,
there,
yeah.
more.
In the long term,
More,
you're going to create more.
You do. I think under and I'm not an expert in this. My understanding is, and we can totally evaluate this, but my understanding as well is that normally under the state constitution, it's not like you just can go in and say, oh, we're doing an abatement here. Effectively,
No,
you can, but you have to designate things under a
Yeah.
specific certain category. Often it's you're designating a blighted property or.
I did check. It
But should we
doesn't
stay
have
on
to be blighted.
Should we stay on the developer
Yeah,
view, the financials, before we go too far in the process? And
Yeah, no, I was just saying there are ways to skew.
This poor guy's like, he's a go, man.
But we
How much more questioning do we have for him? So we can wrap up.
I think we're done.
Is there anything else that we didn't ask you that?
We should
Public-
wait for public comment.
public
that's
comment?
just in case.
Do you want to stay here for public comment? Or-
Well, if there's public questions on my presentation.
Oh, really?
Yeah.
Okay.
Yeah. If you're willing to do that.
We got 5.
So can we just ask first, limited to questions for Aaron? And
I don't think we can. I think we have to take public comment on whatever people want to talk about.
okay.
Yeah, just whatever.
Right.
No. I
I mean,
meant
if the
first.
consensus is you want to take questions
Right.
from the public, you can open it up to that if you so choose.
Right. That's
All right.
not public comment.
Yeah, sorry, not public comment,
Not
questions.
Yeah.
comment,
Yeah.
but specifically questions.
Okay.
Yeah.
So if we
All right.
can limit it to that
Sure.
Questions about
Let's do
the presentation.
presentation. So if members of the public have
We
questions.
have one person in the
about
room.
Aaron's-
You know? Okay. People online, would you like the opportunity to ask a question about the presentation we've just heard? And if you're there, you can raise your hands. We'll recognize you.
All right, John. Go ahead, John.
Yeah, hi, John Monroe, 413 Grove Place. I was there a little earlier. We headed home and got on the Zoom. I was just wondering if anyone at Mr. Graves' firm who is not present was involved in preparing this presentation. And with that in mind, would he be presenting tonight in his capacity as a representative solely of the Planning Commission or also of the professional organization he belongs to that works in this field? Thank you.
This was just me presenting as myself as a member of the Planning Commission. Thank you for the question.
Anyone else?
Thank you.
Thanks for the question. Anybody else online who would like to ask a question?
No, okay.
No?
No, nothing.
There we go. Thank you so much.
Excellent.
Thank
All right,
Really-
hopefully it helped.
Yeah, no,
good.
very,
Again, it's the math behind it. If you have any questions, I'm here.
Also, thank you to Jennifer Iannacone, who's on the line and who provided some supplementary intros.
I think she had to drop, but
Okay.
appreciate it.
Thanks.
Shout out.
Nonetheless, though.
Yeah,
Thank you.
thanks
Thanks,
everybody.
Aaron.
Thanks, Aaron.
Have a good 4th of
Appreciate it.
July, Aaron.
Thanks, you as well.
Okay, let's, committee reports is the next on the agenda. I think we're gonna skip over that because there's no one here to deliver or receive a committee report. Now it's time for actual public comment, for any topic. And let's go back to, no, the room says no. Okay, back on the line.
Do you want to set a time?
Oh, yeah, do you want me to do that? Is there anybody who wants to give a public comment?
I'm assuming maybe yes.
Oh, okay, then can I hook up my,
Yes.
color timer?
Right.
Alright.
And then if we,
Share.
yeah, there we go.
There it is.
Okay, cool. Alright. Okay, let's see. If you're online and you would like to give a public comment on any topic, please raise your hand. So I'm going to be using this color timer, so I'm not going to cut you off. I'm just going to ask you to watch the timer and, you know, end your own comments when it's time. Who would like to be first? Who do we have first?
Anybody online?
Yeah, anyone online who'd like to make a public comment, please raise your hand. I'm not actually seeing any hands raised. So maybe there is no public comment.
No.
Okay.
Okay,
Okay,
last chance?
Yeah, last call for public comment. Nope, no hands.
Okay. All right. No color timer, everyone. Sorry. Okay. Any announcements? Anybody? Mayor? Anybody?
We're good.
No. Okay.
July 2nd,
July.
the day that.
John Adams Day.
There we go. That's the announcement for today.
Today is actually Independence Day for John Adams. They
Okay.
actually adopted the resolution.
That was the vote. That was the vote day.
That was the vote day.
Okay.
They had a quorum, they voted, and then those damn lawyers got involved in the editing of the document, so it took
All
2
right.
days.
As long as we're doing announcements, everyone tune in for Switzerland versus Algeria
Oh, there we go, Jim.
coming up at
We're coming to
10:30.
your house, right? To party?
I won't be there. I'll be somewhere else. Okay. We cannot take a motion for him.
Yeah, we just
We
adjourned.
will just.
We adjourned by consensus.
Will become adjourned on its own.
The time
thanks,
is
everybody.
8:45.
Thank you.
Have a good holiday, everyone.
Thanks, you
Thank
too.